Hey everyone, welcome back to the channel. Today I'm diving into a key concept in finance that can give us clues about the economic future. The bond yield spread. Ready to uncover what it means and why it's important? Let's explore it through an engaging story. Meet Lily and Jake. Lily and Jake are both keen investors looking to understand how the economy might perform in the coming months. They've been hearing a lot about something called the bond yield spread, and are curious about what it reveals about the economic outlook. Lily's story, the bond yield spread basics. Lily is new to investing and wants to grasp the basics of the bond yield spread. She learns that the bond yield spread is the difference between the interest rates, yields of two types of bonds, government bonds like US Treasury bonds, and corporate bonds issued by companies. What she learns. Government bonds are considered very safe, while corporate bonds carry more risk because companies can go bankrupt. Generally, corporate bonds offer higher yields to compensate for this risk. The spread. The bond yield spread is simply the difference in yields between these two types of bonds. For example, if a government bond yields 2% and a corporate bond yields 5%, the spread is 3%. Jake's story, what the bond yield spread reveals. Jake, who's been investing for a while, knows that the bond yield spread can tell a lot about the economic outlook. He looks at the spread to get clues about what might be happening in the economy. Normal spread. When the spread is stable and relatively narrow, it usually means investors are confident about the economy. They see corporate bonds as a safe bet and aren't worried about a recession. Widening spread. When the spread starts to widen, it can be a sign of trouble. If investors think the economy might slow down, or if companies are facing financial problems, they might demand a higher yield on corporate bonds for the extra risk. This widening spread can indicate that a recession might be on the horizon. Narrowing spread. Conversely, if the spread narrows, it might suggest that investors are becoming more optimistic about the economy. They're willing to accept lower yields on corporate bonds, signaling confidence in economic growth. Understanding the fundamentals. So why does the bond yield spread matter? Investor confidence. The spread helps gauge how investors feel about the economy. A widening spread can suggest caution, while a narrowing spread often signals optimism. Economic indicators. Changes in the spread can be an early warning system for economic shifts. For instance, a sharp increase in the spread might signal economic uncertainty or upcoming recession, while a decrease might indicate a recovering or booming economy. Interest rates and risk. The spread reflects the difference in perceived risk. Wider spreads mean higher perceived risk in corporate bonds, while narrower spreads suggest lower perceived risk. Wrap up. In summary, the bond yield spread is a powerful tool for understanding economic trends. By comparing the yields of government and corporate bonds, Lily and Jake can gain insights into investor confidence and potential economic shifts. Thanks for tuning in. If you found this explanation helpful and want to learn more about investing and economic indicators, hit that like button and subscribe to the channel. See you in the next video.